Is your trading app playing tricks on you? In today's fast-paced world of financial technology, trading apps have become indispensable tools for investors at all levels. They promise seamless execution, easy access to global markets, and user-friendly interfaces. However, as users become increasingly reliant on these tools, they may be unaware of subtle tactics and underlying issues that can impact their trading experience, and ultimately, their financial returns. This article examines the ways in which your trading app might be playing tricks on you, and provides actionable insights on how to avoid falling into these traps. One of the most popular marketing tactics employed by many trading apps is the illusion of zero commissions. While this sounds like a dream come true for cost-conscious traders, it's important to scrutinize how these apps actually make money. Zero commissions often come with hidden costs, such as payment for order flow, PFOF. For example, Robinhood, a popular app in the United States, receives compensation from certain market makers for routing your trades through them. While the app might advertise commission-free trading, it benefits by choosing routes based on financial kickbacks, which could mean a less than ideal price for your trade. Another factor to consider is wider bid-ask spreads. Imagine you're buying shares of a popular stock. In a competitive market, the difference between the bid, buy, and ask, sell prices should be minimal. However, if your app routes your order through a specific market maker with less competitive pricing, you might end up paying $10.02 for a share instead of $10. This small difference can add up, especially in high-frequency trading. In many cases, these subtle pricing tactics may not be evident on a single trade but can accumulate significantly over time, impacting your overall returns. The gamification of trading is another area where trading apps can potentially play tricks on unsuspecting users. Many platforms use tactics derived from gaming and social media. For instance, when a trade is completed successfully, some apps like Webull use animations or confetti effects. This visual feedback may give users a dopamine boost, encouraging them to trade more frequently without thoroughly researching each decision. Apps like eToro also feature top traders with high returns, which can pressure newer or less experienced users to copy their moves without understanding the risks involved. Additionally, some apps send alerts during periods of high volatility, such as a sudden price increase in a trending stock like Tesla. This creates a sense of urgency, prompting users to make hasty trades based on the fear of missing out, FOMO. Trading apps that emphasize frequent trading or highlight other users' success can unintentionally encourage users to take on more risk, leading to emotional and potentially costly decisions. Algorithmic trading and recommendations powered by artificial intelligence are widely promoted features in some trading apps, but users should question the accuracy and motives behind these recommendations. Here's how these systems might work against you. For instance, let's say you receive a recommendation to buy a specific tech stock. If the app's algorithm is built on outdated or biased data, it may overlook recent company performance or ignore changes in industry conditions. An algorithm might, for example, suggest buying a streaming company without factoring in recent competitive losses. Additionally, some trading platforms may promote assets tied to their parent company or partners. Imagine your app frequently suggests buying exchange-traded funds, ETFs, managed by the same firm, even when these funds aren't performing as well as competitors. In this scenario, the app's algorithm could prioritize profits over objective recommendations. Furthermore, an algorithm set to recommend stable, blue-chip stocks like Coca-Cola or Apple may struggle to adjust when markets shift dramatically. This limitation can leave you vulnerable in times of volatility if the app doesn't reassess your portfolio. In these cases, relying solely on app recommendations without additional research can undermine the effectiveness of your trading strategy. Even if an app advertises free trading, users can still face a range of hidden fees that impact their bottom line. Be vigilant for charges that include inactivity fees. For example, some apps charge a monthly fee if you don't trade within a specific period, such as 3 months. This can be problematic for long-term investors who prefer to buy and hold rather than trade frequently. Another common cost is withdrawal fees. Extracting your funds from the platform might come with a fee, especially if you opt for a wire transfer or if your bank account is in a foreign country. For instance, some platforms charge up to $25 for each withdrawal made via wire transfer. In addition, many trading apps lock features like advanced market data behind a paywall. Robinhood Gold, for instance, charges users a monthly fee to access additional research reports and market data. While these features may be helpful, they're not always necessary, especially if similar information is available for free from other sources. These hidden costs can subtly erode your capital over time, affecting your returns without you even realizing it. While many users focus on the financial aspects of trading, the security and privacy of your data is just as critical. Your trading app likely has access to sensitive personal and financial information, making it a potential target for data breaches and misuse. Ensure your app uses robust encryption. For example, most reputable platforms like Fidelity or Charles Schwab use 256-bit encryption, but if your app lacks strong protocols, your data could be vulnerable. Additionally, some trading apps may share or even sell your data to third parties for advertising purposes. For example, certain free apps have privacy policies that allow data sharing with affiliates, which could expose you to targeted ads or marketing emails based on your trading activity. To further protect your account, make sure the app offers two-factor authentication, 2FA, and other security measures. Apps like TD Ameritrade provide additional security tools such as facial recognition and 2FA to help keep your account secure from unauthorized access. An app with weak data security practices could expose you to identity theft, financial fraud, or even phishing attacks, potentially putting your investments at risk. Not all trading apps offer the same range of assets or market access. Many are limited to stocks and ETFs within a single country or region, which can prevent you from diversifying globally or taking advantage of niche markets. If your goal is to create a well-rounded investment portfolio, look for apps that provide access to international stocks. Apps like Interactive Brokers, for instance, offer access to stocks in over 33 countries, allowing you to diversify beyond domestic markets and reduce your exposure to single-country risks. If you're interested in commodities like gold or forex trading, platforms like Forex.com or IG Markets might be more suitable than apps that limit options to stocks and ETFs. Advanced traders often use derivatives to hedge positions or leverage trades. Platforms like Thinkorswim from TD Ameritrade offer a wide array of options and futures. Apps that lack access to these products might restrict your ability to execute sophisticated strategies. By confirming the full range of available assets, you can make better informed choices for a balanced investment strategy. Some trading apps implicitly push users toward short-term trading strategies by highlighting day trading or promoting hot stock picks. However, frequent trading can lead to increased costs and a greater likelihood of emotional decision-making, which is typically less effective than a disciplined long-term strategy. For instance, if you frequently trade stocks like AMC or Tesla, you might face short-term capital gains taxes, which are typically higher than taxes on long-term investments. This additional tax burden can cut into profits, especially for day traders. Apps that spotlight trending stocks can lead to impulsive decisions. During the GameStop surge, for example, many investors bought in due to hype without considering the risks, resulting in losses for those who entered late. Additionally, high-frequency trading on stocks with low liquidity can lead to slippage costs. Buying a low-volume stock, for instance, could result in a purchase price higher than anticipated, reducing your potential returns. Trading apps that don't emphasize the benefits of long-term investments may indirectly encourage users to engage in costly, short-sighted behaviors. To avoid falling into these common traps, it's essential to use your trading app with a critical eye. Educate yourself before following an app's recommendations. Perform your own research to ensure your decisions align with your financial goals. For example, read up on a company's financials before buying in, instead of relying solely on an app's buy signal. Also, take the time to read through your app's terms and understand all potential fees. Confirm if there are fees for account inactivity or wire withdrawals to avoid surprises. Avoid over-reliance on features like push notifications and trending stocks, which may encourage impulsive behavior. Set limits to avoid getting caught up in the daily ups and downs. Define your risk tolerance and financial goals, and stick to these boundaries to avoid making trades driven by emotion or marketing tactics. In summary, while trading apps offer convenience and accessibility, users should remain vigilant against potential tricks that can erode profitability and security. By educating yourself and using these tools wisely, you can leverage them to enhance your investment strategy without falling prey to hidden pitfalls.